Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this quick short video, we're going to look at Dick's Sporting Goods, and we're going to see if it's undervalued or overvalued. We're going to check if it deserves more due diligence. You're going to want to watch this video. Let's take a quick glance at their financials. You see here their revenue since 2012 made $5 billion, $5.8 billion, $6.2 billion, $6.8 billion, 7.2 to 7.9 to 8.5 to 8.4, 8.7, 9, and their trailing 12 months is currently at 11 billion. So they've been steady increasing their revenue. Their gross profit, of course, has been increasing. They've been maintaining their debt. Operating income has been increasing. Big jump in 2021. The operating income went from 442 million to 916 million. And that right there is something that deserves more due diligence. It's most retail companies made quite a bit of a jump because of COVID related. Once COVID opened up shopping, a lot of people started shopping more. So that can be attributed to that. And that's something we definitely want to look at because this will affect the free cash flow DCF and it'll give it a higher DCF. And we want to pretty much try to maintain what they've been doing. As far as operating income, they've been declining over the last few years, going from 429 million to 522 to 544, 577, and then 543, 545, and then 2018, 19, and 2020, all under 500 million for operating income. They have been using some of their free cash flow to buy back some of their shares, which is a positive thing. That's why I like doing the free cash flow DCF. We mentioned before that some of the benefits to companies that have a lot of free cash flow, they can reinvest in their company, they can make acquisitions, and they can buy back some of their shares, which is all positive things for the investor. If we take a look at their balance sheet, their total cash and investments, they have $1.6 billion for 2021, and total current assets, $3.7 billion. Compared to total current liabilities of 2.5 billion. So their debt is under control and it seems like they have enough assets and cash to be able to pay off their debt in a reasonable amount of time if they needed to. So if we look at their cash flow starting from, let's say they were negative in 2009 and then 2010, 206 million, 230 million, 208, 219, 118 drop. Starting pretty much in 2015, they had quite a bit of positive cash flow at 256, 273, 337 million, 271 million, 514 million. Then a drop here 2020, possibly due to COVID and shutdowns, to 187, and then a big jump here of $1.3 billion in free cash flow, again, possibly due to the opening. So again, having to do with COVID, which is something we want to keep in consideration when we do our DCF. So let's take a look at my free cash flow DCF. We'll start off with the base case, and all three have in 2021, obviously 1.3 billion in free cash flow. And just looking at the trailing 12 months, I think they'll somewhat continue that. So for base case, we're assuming a 6% growth. And then 2023, I don't think they'll make more than 1.4 billion. So a -6, -10, kind of like maintaining. The base case here is maintaining what they've been doing based off of before COVID and the major jump and the major drop due to COVID. So these are kind of like more realistic numbers based off of historical data. And with that, it gives it an intrinsic value of $112. Now, the best case scenario, pending that they're going to continue getting those massive jumps, that massive increase in revenue that they've gotten the last year, then you would give it an evaluation of 173. I do think that's a little bit too optimistic. And worst case scenario, we assume that there's going to be a bigger drop in the next few years. And I'm leaning more towards the worst case scenario. I would say this is, for me, a buy if it drops closer to $77. And the reason for that, there are some positive things. If we look at their chart, they have been a positive company. But if we look at their 5-year chart, their returns total for 5 years was 110%. And it hasn't been beating the S&P every year until just this year, where it just had a major jump. So even though they have a forward PE ratio of 9.3, which is excellent compared to their industry average, which is at 12.58, I'm concerned that it was mostly due to COVID. And another ratio that some analysts look at to say that this is undervalued, they look at the PEG ratio, which this one's at 0.74, and it's similar to the PE ratio, but it takes the company's expected growth rate into account, and the retail average is 0.96. They do have 730 stores. They have warehouse stores. They have about 125 specialty stores, and the specialty stores don't seem to be as successful as their regular stores. So there was a major demand for activewear after the pandemic, after the opening. So I think that's why this company grew so quickly this last year, and I don't think it's going to be maintained. I do think it's a good company, but not at this price. There are more competitors now. They were able to kind of survive Amazon, but Amazon's still strong, Walmart's strong, Lululemon, Bass Pro. Then they have kind of even Adidas, for example. Their direct-to-consumer business constituted for about 41% of its 2020 sales, and that's up 25% in 2015. So some of these companies now, they're selling their own stuff online, so that's going to affect Dick's. There's some other companies coming in that seem like they're starting to compete with Dick's, like Hanes Brands or Anta Sports Products. I think they're also doing positive things. They're not as big as Dick's, but they're on the come up. And Dick's hasn't done anything to show that they've built their own moat. So the competition is coming. And although stores have increased 60% over the past 10 years, the sales growth is below 4% in the last 8 out of the 10 years. So it's a combination of business, more business. It's a combination of companies like Nike's and Adidas. They're reducing their dependence on wholesale by themselves investing in e-commerce. And it's for those reasons that I'm more inclined to lean towards the 77 evaluation. You can maybe sell some puts at around $80. And if you get filled at that price, I would say that's a positive price because it's not a terrible company. I don't think they're going out of business anytime soon, but they haven't built a moat for themselves. There's more competition. Their recent spike in sales and revenue can all be attributed to COVID. So that's why their price, to me, is overvalued at that price that it's currently trading at, $119.74. And I think it will come back to the low 80s. And if it drops below 80, anywhere between 70 to 80, I do think that's a good price to get in. And I'm staying away at this time. I do think it's overvalued. And that's my video. Thank you for watching. See you on the next video.